All right, the recording is live, so we're here with our best friend. It's been a little bit of a delay getting you up and running. Our schedules have been a little bit out of sync, but I'm glad we're finally able to have our first session. So how's your trading been since the first event?
It's been so I did try to do a paper trade
Hmm.
couple of times with the 20 MA strategy, but I wasn't able to get further ahead because I was swamped with other things, couldn't find time to get into that.
That's the hard part, right?
So, yep. And my work has been demanding as well for the last week or so. So it's cooling off. So hopefully I should find more time this week or next week
Beautiful.
to get started.
Okay, that's good stuff. Yeah, some of
Yep.
those just run from 4 o'clock in the morning to 10 o'clock at night, and you
Yeah.
just do it day after day. So I get
Yep.
it.
Yep.
All right, well, let's see what we can do to kind of to offset that a little bit, right? Because that's
Hmm.
actually it's an advantage because you're not too close to the market. That's where most people mess themselves up because they're like, I can trade. I'm gonna replace my job so fast, and then they do, but it's with a less
Yep.
quality job when they have to go back to work. So
Yep.
so let's avoid that. Let me go ahead
Hmm.
and see if I can screen share my trading view, and we'll go ahead and just get started. Are you able to see that?
Yes, it's loading up. Yep, I'm
Okay.
able to see it.
All right. Were you able to watch any of the Zach episodes or not yet? It's okay if not.
Cicero, I am halfway through, so I
Oh wow.
am right with my trading plan. I
Mhm.
think I have my trading plan. I have two different trading plans that I put forward, one with options and one without options, because I don't know how the 1% will work with the options, and the price is fluctuating a lot.
Oh yeah.
So I didn't know that, but I still put it there to see which one would work and
Mhm.
see what we can follow.
Okay, for sure. And that's
Yeah.
kind of the journey is figuring out kind of which.
Uh-huh.
I don't know if you ever watched a lightning strike in slow motion, but basically
No.
it's really cool actually if you get a chance to watch it. So basically,
Hmm.
what happens is there's a charge in the clouds, a charge in the earth, and what the earth does is it shoots up these little probes, right? And we
Hmm.
think typically lightning goes from the top down. But it
Hmm.
shoots up all these little feelers, and then the one that just happens to have the most efficient route is the one that gets the lightning strike, and that's what we see. So it's kind of
Ooh.
cool if you ever get a chance to see that, because like you don't realize it, but that's actually what causes like your
Hmm.
hair on your neck to stand up when lightning's about to strike. You're probably in one of those, and you're just kind of amplifying it because you're made of water. So,
Hmm.
um, so yeah. So
Hmm.
with that in mind, the approach for you, since you're super busy and you don't really have a lot of time to sit in front of the charts all day, um,
Hmm.
options is a little bit risky, right? Because you can't.
Right.
Yeah.
Hmm.
Yeah. So what we can do, however, is we can use those options the way that they're intended to be used, and we can use them to, acquire shares and sell shares, and
Hmm.
protect ourselves
Hmm.
against volatility in the market. So I still feel like
Hmm.
there's still a place for those,
Okay.
um, and it's up to you how you want to structure your stuff, and that's the beautiful part about all this is you pick everything.
Hmm.
Um,
Hmm.
so I think, just generally speaking, are you comfortable and confident in the approach where we're doing the whole process? Like we're making consistent contributions, we're putting the
Oh
bulk of it in
yeah.
passive income. Okay, so you've
Yep.
got a
Yep.
relative sense of that plan, and you feel like
Yes.
you could do it. Okay,
Yep.
then all
Yep.
right. So the rest of it doesn't really matter as much, right? You can
Hmm.
you can completely mess up on either equity or options and still be okay over time. It just sucks a little bit.
Yeah.
So let's not do that. But
Okay.
all right.
Yeah.
Okay. So that's pretty good. So were you able to do any back tests by chance? I know you said you were.
No.
No? Okay.
No.
All right. Did you have any other strategies you might be interested in, or do you currently have a coach?
I don't have a coach right now, but I've
Okay.
started learning about the strats,
Oh,
what
okay.
ADX teaches and coaches, I guess.
Okay.
And I know Ethan, not Ethan. I think Ethan, right?
Yeah,
Ethan
it
from
is.
PB also does that. But I'm not into. I'm just taking it on my own pace of learning about it.
Okay.
I am just starting with that from learning perspective.
Gotcha. Okay. Are you familiar with the wedge? The wedge pattern?
No,
Oh,
no,
okay.
no. I've
So
just started. I'm not into
gotcha.
any of that yet.
All right. Well, let's just kind of do a high level view of it. So ignore all these
Hmm.
candles, right? We're just going to look at this
Hmm.
blue area right here. Actually, let me erase these lines as well because I don't need any of this to help explain this to you. So here is a group of people that have shares, right? So this is supply. They have the shares. They want to sell it. They want cash, right? So that's where the sellers are. And then we've got down here, we've got a group of buyers. They have cash. They want shares. So they're the buyers, right? They're going to buy. Price will go up. Shares will be sold up here. Price will go down. So in a wedge, that's just a fancy pattern that tells a story. All patterns just tell stories. So yeah, price kind of goes up, boom, boom, boom. And then with a wedge specifically, you've got a setup like this, right? It's just lower highs, higher lows. The price is compressing. And behind the scenes, what's happening is you've got buyers, they push the price up. Sellers say, okay, this is all they're worth for me, so I'm going to sell. Enough of them sell, the price goes back down. Then the buyers pick it up here instead of all the way down here, and they say, okay, well, it's worth it to pay a little more, so I'm going to buy some. I'll just put the box right here. This is where I want to start buying it, and obviously enough people jump in, so there's a level there. That forms a higher low, and then the sellers step in, and they're a little more eager to take some profits. They say, okay, well, I want the price to maybe go down from here, so they sell. Buyers buy, sellers sell, and the price just kind of compresses. That supply and demand compression is what leads to some nasty breakouts. And what we have with the strat specifically is a way to visualize that from candle to candle rather than looking from high to low to high to low. It's all just taking place in a much smaller time frame. And I say smaller time frame, but really what I mean is it's on the higher time frames themselves. So if you were to take, let's say this, for example, this just circle these guys, and I'll draw some vertical lines so we can kind of look at it. I'm looking at these two candles right here. And if I go down to maybe the 30-minute, let's see where that was. May or may not see a wedge in here. All right, so it looks like we don't. But what we do have here is we've got some range of price, right? And then we've got a smaller range, and then it releases. So if we go back up to the daily, a little bit easier to visualize here on the higher time frame. If you're looking at the strat specifically, a lot of those setups, I'm just going to ignore this guy. I'll just erase everything. We'll start fresh. So this is what I'm looking at, right? So if we look at this red candle here, we've got a wick on the top and bottom, and you're familiar with the candles themselves and all that, hopefully?
Right.
Okay.
Yep.
All right. So this represents the highest point the price went. This represents the lowest.
Lowest point.
Yep. And then within that range, we've got an even smaller range where the price occurred the next day, and the price was contained within this range. So for the strat, what we do is we look at the next candle here, and we look for a directional break outside the range of this smaller candle. And that's a Harami breakout. If you're not familiar with the strat, that's just an inside candle break. And Harami just means it's pregnant, basically. So this would be the mother, this would be the baby, and then the breakout. So that's kind of what a lot of the strat boils down to if you really, really dig into it. Now, that's obviously an oversimplification because it gets a lot more complex. But, but that's one of the core concepts. It's just looking for those compressions of price and then release of price. And you see the same thing with Bollinger Band strategies, MACD strategies, pattern traders like wedges and bull flag breaks and things like that. So a lot of this is all the same. It's just different skin on the same bones, right?
Right. Okay.
That's all. So that's why I'm not super excited when I like new traders. I know we all want to play with the bells and whistles and find out, the one best strategy and stuff. But what a lot of traders do is they tend to put too much emphasis on the technical analysis and learning those strategies, and they don't learn how to actually apply them, right? So that's what we're going to do. We're going to focus on one strategy. You pick, right? Because you can always swap them out. I don't really care what you do. But we're going to look at the literal implementation of it and kind of the obstacles you're going to run into. So if we were to use
I was actually the one that I liked was the 20 MA because that's what I was using for my paper trading.
Okay.
Right. So the screener that you provided that's on the pin on the R2R forum, that's the screener I pulled up, and I was able to fetch a couple of stocks and do the paper trading with that. I think I did 4 stocks. I picked up 4 stocks and I did the paper trading with that. But I was also interested in parallel on the strat, so I started learning about it on a separate note, not for trading per se, because there are too many jargons in there, too many technicalities in there that I don't even understand right now. So
it's a system.
Yep.
Okay. Do you have one of the ones that you grabbed for paper trade? Do you remember when it was and kind of what?
Yeah, I actually posted it also. We had a chat about it as well a couple of weeks back. It was in our new channel. So there was a BMA, AEP.
Okay.
And then there was ABL, I believe where did I put it? Yeah, ABL.
Okay.
There was one ABL, BMA, and then AEP. These were the three things that I tried it out.
All right. So I'm sorry, BMA, AEP, and what was the last one?
ABL.
ABL. That's what it was. Okay.
Yep.
All right. For some reason, my brain was thinking anti-lock brakes, but that's not. That's ABS, and I was okay. So, all right. So let's take a look. So I did. Yeah, I was looking in the other channel. I didn't see the Discord one. All right. So this was on. Do you remember what date that was? I see your BMA profit was posted on August 30th.
Yeah, it was around that. Let me see if that's still.
Were these on the daily time frame as well?
This was everything was on a daily time frame. Okay. Yes.
Perfect. All right.
So yeah, August 21st. No, 26th.
26th.
So
okay.
26th was when I was looking at it. I think I sold it around August 30th.
Okay. So is it this one here, do you think? This a break of this guy and then the stop loss?
Yes.
Okay.
Yeah.
All right. So at the time this wick formed, this would have been a solid candle, right? So just for anyone who was watching this, because the wick just kind of shows the rejection there. So in this case, it looks like you had a stop loss right here. Were you just busy and didn't catch that, or was that a...
No, this was a BMA, right?
Yes.
So I have that screenshot. Why is it not coming up? So this was at the price range of 53.63 is when I had my, and it doesn't give me the date. Great. It was on a 1 day time frame. So the MA was 52.20. So maybe that was not it.
Okay. All right. So it looks like maybe there's an opportunity to fine tune this, right? So if we're getting two different sets of data here, that means that there's some sort of disconnect. All right, so let's look at the overall concept itself, right? So you're still looking at the opening price of the red candle, waiting for the price to break, and then you're using the lower of however many candles.
Lower of both one of these candles that those are next to.
Okay, so from your perspective, this would have just been a stop out if that was the candle, right?
Right.
Okay.
Yes.
All right. So I just want to make sure we're on the same page with that. So maybe you entered up here or something, or.
Yeah, I haven't. Unfortunately, I haven't captured the date thing on there. I just at least on my screenshot, I don't have the date. I have the values out there, but I don't have the date.
That's okay. Okay, so it looks like that's the only opportunity I see, and like the candles are below here and stuff. They wouldn't have been at the time, but I mean, we could have passed that. We could have taken it either way, right? It would have stopped out.
The moving average definitely is the line is below the red candle. So that was one of the signals that I was looking for. Because I remember this because I had to watch through our first video a couple of times to get to understand that part.
I gotcha. All right. Yeah. Well, so here's the cool part, right? So even if we took this one and lost, it's okay, right? Because we see another opportunity right here. Okay, so even if we took this one and lost, that's okay, right? So if we're using something like the 1% rule, we'd be 1% down, 2% down, and then we have another opportunity right here, and that hit target.
But isn't that a bigger candle, like bigger potential of loss there?
It is, but
bigger risk.
Yeah. So if we decide to take a bigger risk, and if we zoom out a little bit, I mean, it's close enough to justify, but it is, we can consider that a risk. It doesn't really affect the probability that much, but we need to make sure that we implement something like the 1% rule. So this one, this risk right here is about 6%. So if we use the 1% rule, it takes that 6% risk and it shrinks it down to 1%.
1%. Okay.
Yep. So if we just look at the numbers objectively here, we would have lost 1% overall. We would have lost another 1%, so 1% of 99%, and then we would have gotten 2% plus in return from the one profit. So we have
we would have,
Yep, 33% win rate so far, and we're break even roughly, right? All right, and again, that's when we can filter stuff out. Like even if we didn't take this one, we'd still be 2% down, and that's okay. 'Cause
Right.
now this stock is in an uptrend. You know, there's no like sideways choppiness anymore. It's directional.
Mm-hmm,
It's over
mm-hmm.
the recent highs and stuff. And then we're just really looking for something like this, right?
Right. Mm-hmm.
So if we find a stock that has a good history of a couple of these, the likelihood of it happening again should be pretty high, and that's all we need. We don't need like the best stock at the best price.
Right.
You know?
Right. Right.
All right, so let's take a look at some of the other ones here. You had BMA, then you had AEP.
ABL.
Oh yeah.
Yeah. AEP.
All right, we'll look at ABL first.
Mm-hmm.
All right, so I kind of like these. Was this around the same date roughly?
ABL. Yeah, it was. It should have
Okay.
been around the same date.
Okay, so let me look for some opportunities here. So we've got this guy right here potentially. Then this is again, it's a slightly expanded risk range. So maybe you do, maybe you don't like it. I don't know if that would have hit target. Let me just take a look here. And this is the cool part.
So this was around 10:36 when the candle, the previous day candle opened up. So, and then the stop loss was 991. Like the wick on that candle was 999. The bottom wick on the candle.
Okay, so 991 was the low of the candle in question?
Yes.
Okay. So it was probably over here somewhere then. This one right here has a low of 991, but it doesn't have an entry after it.
Yeah, and the opening of the candle was 10:36. Is that 10:36?
1031 on this one. Let's see here. Let me just map these out. Sorry, let me just erase all these drawings. So, okay, so you said 991 was the low. And then 1036 was the opening price?
Yes.
Okay, easy enough to map out. So now we just got to find a candle that fits, right? All right, so opening price here and low here. This is the candle right there.
Yep.
Okay, so this one doesn't have an
Stop.
open. Because this guy doesn't break over that red line.
Yes, so that hit a stop loss.
Did you enter on this candle before it broke out?
No, I just mapped it out. I never entered this. I just mapped it out and I never entered this.
Okay, I got you.
It would have hit the stop loss. No, I wouldn't even have entered there because it never made it to the price range.
Absolutely, no trade.
Right.
Easy. Save your money.
Right.
Now this one. So if we're looking at this, you know, if you wanted to look like once this candle opened and closed, it then becomes the next candidate for the following day. So this would then be the next opportunity here, and it didn't break over. So no trade on that one either.
No trade on that one.
The next red candle gets below the line. So no trade on this whatsoever. You would have entered on this guy probably back here if you were watching it ahead of time, but that just would have been a stop out at that point.
But then isn't the MA line too close to the candle?
So this right here?
Yeah.
No, this is ideal. This is what we want. We want tiny red risk near the moving average. I don't really like that it's the first green slope. Like ideally we get at least one, you know, up and then down before we get that. But you know, it's just kind of sideways, so that's a risk factor, but it's not necessarily a deal breaker. Yeah. So in this one, I mean, I don't really like this chart too much personally. Like just looking at this, like it has a history of going sideways. Yeah, like looking back here, that's garbage. There's nothing you can do there. So that's okay. That means that maybe it's the fuel that we're putting into this as well. So there's some factors here we can look at. So let's take a look at AEP next. Oh, this is a beautiful chart. So this I like, right? This is nice. Let me just look back a little ways so we can see that we've got some good volatility. We got some good directional moves on here. We got some larger moves. We got some good sustained trends. We got a good history of stuff. But looking at this, after, you know, when it starts to sell off, it sells off pretty aggressively. So
pretty aggressively, right.
So this tells me we're going to want those stop losses in place, and we want to
restrict stop losses.
Yeah, you see these? That's that's all. So we can identify a risk factor. It's like getting into a relationship. If you know somebody's like got a personality quirk, like if they're mean to service people, you know, just don't go out. You know, don't go out with them for long. You know. All right, so we got some good opportunities here. Now, if you were looking at this one, for example, this would not have been an entry.
I was okay. So here the opening price was 98.56, and then the closing, the lowest wick was 98.02.
Oh, okay. A little 54-cent range there.
Yep.
Oh, you said 98.02.
98.02. Yes.
Perfect.
And then the opening price was
So this guy.
98.56.
Was it this
Yep.
guy? Oh,
Yep.
look at this. This is beautiful. So you entered on this
Yep.
candle,
Yes.
and your stop loss was here, and it never got touched.
Yes. It never got touched. I sold it on 99.64.
99.64. All right, let's map that out. And then I want to go through the trade and see what I would have done.
Mm-hmm.
Okay, so would you have locked all your shares up or 75% of them?
Yes. No, 70, not 75%. I locked up
Okay.
all my shares on that.
Okay. That's okay too, right? Because you're just guaranteeing that short profit. You get your money out faster, you can do more with it, right?
No, more than that, I wasn't. I was trying to do this in Webull, and yeah, I know long back when I was trading in Webull, it did give me an option when hey, Pookies, can I really quick take this call? It's from my doctor, if you don't mind.
Yeah, go ahead, man.
Sorry about that.
You're good. All right, so while he's doing that, I'm going to go ahead and map this out. Hopefully he can't still hear me. Okay. All right, so he got our entry right here. Go ahead and look at this. So positive moving average slope. He's got a tiny red candle. This is beautiful. Color change right after that. Volume's not that great, but that's okay. That's not a deal breaker. And then we've got our push straight to target. So ideally we'd lock in about 75% or at least the majority of our shares. And then if we want to keep it going, if we don't, that's okay. But at this point, the jar is open, the profits are secure, we're guaranteed a net profit even if it comes back down to hit stop loss. In this case, it did not. So then we can start looking for 5 candle runs. So 1, 2, 3, 4, and then we didn't get a 5th candle. And this one can't be a higher validated low because we don't have 1, 2 to the left. So let's continue watching. So 1, 2, 3, 4.
Sorry about that, Pookies.
Hey, no worries. I was just I was rambling on the recording a little bit so that I could kind of walk through what I would have done here.
Oh, okay. Okay.
So it's perfectly valid to just lock in your shares at a disproportionate ratio. That's how you do it's a frequency trade. That way you get your money back immediately. You can throw it into the next one, right? So don't feel like you have to do one or the other. Okay, so in the alternate realm here, right? What you did here is you had a positive slope on the moving average, a tiny red candle. This is beautiful, right? So you got a color change. I pointed out also that the volume wasn't that great, but that's not a deal breaker, right? We're really here for that tiny risk range, and nothing else really matters. So then, you had a little push, pull, push, and then it went straight to the target. So you locked your shares.
Target.
Yep.
Right.
So now if we wanted to trade with continuation, all we would have done is taken some of the shares.
75% out.
Yep. Yep. More than half is all you need. And then, yeah, just lock those. And then at this point, that magical jar that I talked about, that's open, right? The coin is solidified. It's back in your pocket. You're guaranteed a net profit, even if this sells off and breaks your stop loss and all that good stuff. And as long as the stock doesn't delist, you've got some range.
Right.
That stock could, in theory, go 3 times this distance to the downside. So probably around here somewhere before you started losing those profits. So I like this. All right. So in this case, once we break out, right, this setup is no longer really valid. All we care about is the stop loss. That's it. Right. So we can look for 5 candle runs or higher validated lows. We're always going to be seeing one of those two. So in this case, we get 1, 2, 3, 4, and then we don't get a 5th. So there's no 5 candle run. And this candle, since it broke lower, would put us in a state where we're potentially looking for a higher validated low. But this isn't a good candidate because this guy's lower. So you don't have the 2 candles to the left. So let's keep looking. So 1, 2, 3, 4, and then we don't get a 5th. Right? So no 5 candle rule. However, we do now have, as soon as this candle forms, and closes, I should say, we have a higher validated low. So we can take that stop loss and move it up. And that's a full stop. So now we can look for our 5 candle rule again. So 1, 2, 3, 4. This stock just doesn't want to give us that 5th candle.
Right.
And that's it. So we'd still be in this, and our stop loss would be up here at 101.66, and we'd have locked in 75% of our shares down here for a net profit. We'd have 25% just chilling, right?
Chilling out. Yep.
That's it. So that's beautiful. So
the 5 candle rule, right? Can you explain that to me a little once more?
Yeah, for sure. I'll find an example here. Let me find a good example, I should say, because there's one right here, but I'm like, it's kind of close. We don't want close for these. We want clear demonstration. Okay, can you see the candles between these lines? Just these 5 candles. You can ignore the actual lines. So you see the lows of these candles where the wick is? Okay, so we got 5 of those in a row where that low is higher. So if I were to draw a horizontal line.
So they don't break. Okay.
Yep. and then I just move
They
it
don't
to
break the lower lows.
yes, correct.
Okay.
Or 5. And then as soon as the price breaks there, you'd lock another majority of your shares because it's a partial stop. And then once you get a higher validated low, like over here, sorry, this guy where you've got 2 candles to the left, 2 candles to the right with higher lows, right? We're only looking at the candle lows, and that's the beautiful part because you just have to focus on one dot. Right?
So until then, right? So in the can you go back to the place where you were explaining it to me?
Yep.
Okay, so these 5 candles, right? So my stop loss to start with would be on the lower lows of this candle, the first candle, right?
Okay, so
Original stop loss? No, okay.
yeah, your original
stop
stop loss
lower,
would be down here somewhere.
down here somewhere, right?
Yeah.
So now I'm looking for that 5 candle to break the lower pattern. Now I don't see a candle. So I see this 5 candles out there. So now I move until then I wait, and I move now that I see the 5th candle out there on the top. I move my stop loss from here to here, right? To where you're pointing.
A partial stop, yes.
A partial stop. Okay.
Yep.
So then the next candle, if it breaks, it breaks. But at least I would have locked the profit in that. That's the okay.
That's it. And your full stop is still in effect. So the rest of your shares, like let's say you got in down here somewhere. I'll just draw this out. I think it'll probably be a little easier to visualize. So this would be where your original stop loss is, and I'll make this a thick red line so you can kind of see it differently. So that's our main stop, and then let's say our take profit ratio is here, for example. Make that thin again. So basically, in here we don't do anything, right? Once this gets hit, then we start looking for the 5 candles and all that good stuff. So we enter on this candle. Our hard stop is down here for every single share we have. We lock 75% of them right here, and then after that, over here, we start looking for 5 candle runs. So once the 5 candles form on the close of this 5th candle here, if those 5 candles all have higher lows, we move a stop loss for 75% of the shares that are left. All right, and then once in this case we get a let me see, we get a higher validated low right here on this guy. So we'd sell 75% of our shares right here, and then the stop loss would be moved right up here once this guy closes. So then we would have stopped out right there in that candle for the whole position at that point.
Whole position. Okay.
Yep.
Okay.
And those are minimums. Obviously, you can always lock profit. Like if you see this up here and you're like, I don't want to hold this anymore, you can sell. It doesn't matter.
Right.
We don't want the opportunity cost or the missed profits to dictate our decision making.
Right. Okay.
Yep, and that's it. So for this one right here, we just didn't get a 5 candle rule, but we did get a higher validated low, so our stop loss would just go there.
I see.
Yep, and that's it. Do you have any historical trades that you like, or tickers that you maybe got beat up on, or
a lot of them?
Yeah, I think we all do. All right. Do you have one you wanna throw out there? We can take a look at it. Just the ticker and then a random date.
Not on stocks though. In stocks, yes. EJH. I think I'm still in that trade.
EJ?
But I have lost EJH, I believe. Let me pull that up.
This one here?
Is that, what does it say? Okay, hold on.
eHome household.
No, not that guy. That is a crappy stock for sure. EJH, yeah.
Yeah.
EJH.
Okay.
Yep.
All right, so it looks like there's some sort of earnings chaos or something on this stock. It's horrible. But that's okay, right? We don't really care how big this red stuff is because we're not trading that. What we are trading,
I actually got in at $3 for this guy, and it's like beat up so bad.
Yeah.
It's at 19 cents or 10 cents.
Yeah, that's a little rough.
Yeah.
All right. Well, so that is, as much as it hurts, there's a lesson in there, right? And it sucks sometimes we have to kind of be exposed to that to learn that lesson. But stop losses are our best friends, right? And we can apply this strategy to any of this stuff, right? So if we want to put a filter in and say, okay, I don't want to trade anything under $1, you wouldn't look at anything under that line ever, right? If something falls down here and you're holding it, you'd just sell it, just move on. It's not worth it. But right here, above $1, you've got an opportunity, right? You got a couple of them. You got one here, you got one here, you got one here. Maybe if you like that risk, you got one here. Obviously, that risk range is way too big. You got one here. You would have stopped out on that one, but you wouldn't be in this stuff, right?
Right.
And that's where we can really begin to change our trading, because a lot of people can't get that to be the priority. It's always like, oh, it's going to come back. I'm going to have an even bigger position if I add to it way down here, and then I'll make $1 million. You know, I've done it. Trust me. So, all right. So in this case, right, we've got a pretty easy. I'll just draw lines so you guys can see. You know, that's an opportunity right there. Now maybe that risk range is a little big, so maybe you opt for something small like this, right? That way, if it shoots all the way down here, it's no skin off your back. It doesn't matter. Right. All you're doing is following a checklist. Is it above $1? Is it a small risk? Does it a positive slope? And like, is there anything major that's going to get in the way? Is there an earnings coming up? Is there some sort of reverse split? Do they have an offering that they've discussed? Do they have minimum bid requirements issues? Are they going to get delisted? You know. As long as there's not that kind of chaos, any stock really has potential if we just know what to look for and what to avoid. Right. Like right here, easy opportunity. Easy opportunity here, 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 here. Yeah, now that would have worked. You got one here. Maybe you would have got stopped out on this one because maybe you entered here and then it shot down. You don't know.
Right.
You know, that would have been a good one. This is too big. Risk range. That's too big. Maybe you took this one. Maybe you got stopped out. This one didn't have an entry that broke over. This one did. Maybe you stopped out before you hit that target. This one had an entry, but it stopped out. And that's okay, right? You don't really care too much about the little stops. But you know, like you can endure 15 or 20 of those much more easily than you can endure 15 or 20 of these.
Right.
And that's the name of the game. It's just surviving, right?
Right.
So all we got to do is change the things that we're doing to ourselves and try to identify, you know, specific things that we can avoid. Was there? So you bought this at $3. Did you like the fundamentals or something, or do you remember what compelled you to it?
No, I was it was total blind buy. It was an alert from somewhere that I looked at and I bought. I fell for it.
Gotcha. Okay. Well, that's part of the journey, man. We've all been there. I've done it. Let me look. BlackBerry, I think, was one that I got bid on pretty hard. I think it was somewhere. I think it might have been like in this area. Wait. Yeah, it was around here. I think around 2021. I mean, obviously, I'm trading for a while, so I know I didn't just buy it and hold it for nothing. But I did like the potential that it had, and you know, I caught it like somewhere around here and didn't take profits. I think it was or something. But I also bought calls. I bought a call. It was a longer term call, and then it went down here, and you know, I averaged down like a genius, and then it happened to go up 1,000%, but only when it had one contract. No, I sold it broke even. I only had one contract, but that one contract went up 1,000%, and guess what? I made like $30. That was it. Because that's, you know, my process didn't allow me to take that kind of huge risk on something that was selling off like that. So I was, you know, I prioritized reducing, and then I got my 4-digit runner, but it's just stuff like that. Like, you can't control that. We can't predict the future, and a lot of people hurt themselves trying. So instead, right, just control your risk at all times, and you'll be fine. So like BlackBerry itself, I don't personally like the daily chart, but there are some good opportunities on it. And that's kind of, I think, one of the biggest steps that I think we should add into that trading plan is just looking to the left and seeing if this stock that you're looking at, whatever one it is, has a history of this kind of setup, right? So like this one, I don't really like stuff when it's below the moving average, but you know, like there's some opportunities here. This one looks much healthier as far as opportunities go. This one, right? So I don't really like this one. It doesn't really fit this strategy very well. At least not as much as I'd like. At least not on this time frame. So if I kick it up to maybe the weekly, that's a little cleaner, right? We got some good, strong rejection of the moving average. We got some good, healthy risk ranges on that. We still got a little bit of chop sideways stuff. So maybe we pass on this ticker altogether. Right?
And again, when you look at the time frame, right? So if I were to look at a 1-day time frame, should I expect that move up, the leg up that we are seeing? Would it be is it like a swing that could take potentially a week to go up when you're looking at a daily time frame, and is it faster when you're looking at a 30-minute time frame?
Yeah, so it's gonna be a frequency versus probability issue, right? So if you're looking at the daily time frame, and this I mean, looks bullish, right? It's got green candles, it's got a positive slope, but right now we're seeing some red candles. We're seeing a little bit of a bullish rejection right here, so maybe, right? So if we kick it down to the 30-minute, you know, we're kind of pulling out of it, right? But I don't like this. This right here is not clean. It's not quality. I don't like the spacing of these candles, and there's so many wicks. It's very hard to trade this on the 30-minute. So yes, I'll get more opportunities, but it won't necessarily result in better results, if that makes sense. Now, if you're okay with that, I mean, and in theory, it shouldn't matter too much, right? As long as your higher time frame is telling you you've got a bullish bias or a bearish bias, and you're trading in that direction, it should be okay, right? But I personally would prefer stable trades with good probabilities. While you're learning, right? Because once you get
so daily time frame makes the most sense, right?
Yeah, and once you get like skilled and experienced enough, you could trade stuff like this if you want to. It's just not very healthy, right?
Right.
The concepts are still the same, right? Like if you entered here, for example, and this was your stop loss, obviously you got a plus and minus 1 cent, so you'd be up here somewhere, right? 242, and then 239, and then a target up here somewhere. Let's see, 2-3 cents. That'd be 248, right? It's kind of rough math there. 248, it's way up there. I mean, that would be a trade, and it would make sense to grab that because, you know, if you zoom out a little bit with your eyeballs, you can kind of see that you're just doing the same thing. You're just doing it on a different time frame. So, like, this is what you're trading, right? So it really doesn't matter too much. It's the same concept. You're just waiting for the color change to happen. So really, you're just picking the time frame and the price range if you go down in time frames. That's all. So for this one, as an example, if I were to watch this, that would be my entry. This would be my tentative stop loss because it might come down tomorrow, right? I might have to adjust that. But when the price goes up, that's when I'd take an entry. And if it doesn't, this just becomes the new entry threshold. So my risk gets smaller if the price doesn't go up.
Doesn't go up. Okay.
Yep. And eventually the price will just go. It'll keep going down to the point where it's below the moving average, or the moving average turns negative, right? And then at that point, I just don't look at it. So built-in risk management just by waiting, right? Because logically speaking, in order to get a red candle that opens up here, the price had to have gone over that level. So I would have an entry. So easy peasy, right? I just don't like BlackBerry anyway, but. You know, and this is stuff you can do on, let's just grab Microsoft, for example. Any stock, really, has the same concepts, right? So in this case, we don't really have anything other than this guy, just locally, right? Like, none of this can be traded with this strategy because you don't have the color change, right? You do have a 5 candle rule, but you got to wait for it to come back and then push, right? So this is what I'm watching.
It's also below the moving average, so that itself nullifies the trade, right?
You mean this stuff?
The ones, yeah, this
like that color? Yeah, so you wouldn't really take an entry off of this candle right here because of all this garbage. Yeah. A good rule of thumb is once you have like one full candle down here, you probably just want to pass on the trade.
Pass on the trade, right? Okay.
But if I'm looking at this guy when we're back here, right? When this guy forms, that's a good opportunity. It's just like any other opportunity. There's my stop loss. There's my entry right there, and then the next.
Even though it is below the moving average.
Just a little tiny wick there. It's okay. Like, we don't have a full candle down here. I'm just looking at this candle and this one. I don't care about any of this stuff. As soon as we get a break over that, we can take an entry, and we would have just happened to have stopped out. That's the same exact risk as every other trade. It just happened to have a different end result in that case.
Okay.
Yep. So now if I just flick backwards, right, I'm just going to go back in time. I'm going to close my eyes so I can't cheat, right? I'm just going to scroll a couple times. Hopefully I'm not clicking. Okay. So I just click 3 times. I'm just going to pick a random... let me just pick a random... where's my line? Okay. I'll just pick like this right here, right? Random stuff. Okay. I was super zoomed out. I couldn't see where the little red candles are. So now we just we can walk through this and assess, like, is this risk acceptable for me, or is it not? I would probably say yes. I would use the 1% rule here because I don't know, is this more than 1%? It's it's 2.5%. So I'd use the 1% rule. Okay. It's either going to go up or down. Okay, so it went down. So that adjusts the risk range. That adjusts my number of shares that I buy because of the 1% rule. And then I get a red candle. So that lowers this guy. And I can raise this guy.
To that, yeah. Okay.
Next candle, no entry. Instead, I get a lower range, right? And this is just day by day. I check this maybe, 10 minutes a night. I have a little watch list I run down, maybe like 5 tickers or so. So right here, I'd have an entry.
Right. And does that also hit your stop loss then?
This one, no. So the low here is 14.39, so the stop loss would be 14.38. The low here would be 14.39, so it'd be 1 cent above the stop loss.
Okay.
So same low. Now let's. Oh, I didn't calculate my targets. So this, in theory, would all be done the day before, right? And then the only thing you'd need to modify is if like the if the stop loss, if the low came down before the next day broke, then you'd have to move that stop loss. But in this case, looking for a quick 1 to 2. Let's see what we get. Okay, so we would have hit the target right there, lock in 75% of the shares. At that point, we've guaranteed ourselves a net profit. The coins are out of the jar. We throw the jar away, right? We're just looking for the higher. Yep. So at this point, I can erase all these except for the stop loss.
Stop loss.
I'd like to keep this one here just to have it, just so I know where I took my profit. But ideally, we look for the stuff above here. But let's see what we get. Stopped out.
Stopped out. Right.
So if we use the 1% rule, that's an overall 1.25% return on our portfolio. Sorry, I just got a message there. That was weird. So that's it, right? And then we can look for another opportunity. But here, the candle's below the moving average, so we don't necessarily want this one. And that's it. So it's just a matter of just kind of walking through this stuff. So right here, we get a red candle. Tiny risk, positive slope. I might like it, right? I have no idea what's going to happen. I'm just going to walk through these and see what I get. So
okay, you got an entry.
Got an entry, yep. So let's just, I'm going to eyeball the target somewhere. I don't know exactly where it would be. Probably around here somewhere. Boom, hit. So we lock in 75%, and then we can erase all the other lines that don't matter, right? I'm just looking for the 5 candle rule here. All right. So 5 candle rule. So we'll put a partial stop right there. Would have stopped and then hit both stops, actually. So that's it. So we would have locked another 75% here of the 25% we had left, and then 100% would just stop out there.
Stop out there. Okay.
Yep.
Got it.
And we can just do this a million times if we want. So
over and over again.
Yep. So this one didn't have an entry. So new low, we move our stop loss down. New red candle, we move our entry down. That's it. We still got that positive slope, so it's still worth looking at. Until we don't.
Okay. New red candle.
Yep. So there we go. So now if I get a full candle below this moving average, whoa, that was close. All right, so this would have been an entry, and this is greater than 1%, so I'd use a 1% rule. Okay, so let's see what I get. I'm going to estimate the targets probably around there, I assume. Let me just quick measure that. 2%, 4%. Yeah, okay, that's good. All right, so we would have hit target again, right? So it's the same thing over and over and over again. Let's just move it up here. So we didn't get a higher validated low or 5 candle rule. We got 1, 2, 3, 4, 5. 5 candle rule kicks in right there. Locked in 75%.
That's 75%.
And now we start looking for a higher low candidate, which let's see, we get one right. 16 and 16. Okay, so this is equal. It counts. So this would be a higher validated low in that case. I'd move my stop loss up right there. Oop. Next day. All right, so we stop out right
stop
here.
Loss.
That's it. It's just a matter of just repeating that over and over and over. 1,000 times. It sucks. So now let's go look at a condition where it's not as favorable, right? Let's see if we can find one. Let's find like something like this where it's nice and choppy, right? I'm going to walk through these pretty quick because I don't want to take up the whole thing doing the same strategy, but I want to make sure you got the concepts down here. All right, so here. All right, so we've got that. We got that. Let's see, we got an entry here. We don't know if this would have stopped out, so we'd have to consider it a loss, right? Just for the sake of having integrity here. Okay, so maybe that's one loss. So let's see what else we get here. So candle below, we don't have to look at it. Okay, red candle here. Okay, candle below, we don't have to look at it. And then we got a red slope. So we can ignore all that stuff. All right, so now we're starting to get some red candles. We got a positive slope. Let's see what we get. All right, nothing.
Stopped out. No trade.
No trade. Yeah, there's no entry. All right, so red slope, so we don't even look at it. Yep, no. So it's just literally just telling us not to trade, and all we have to do is listen, right? We don't have to try to build one down and be like, oh, I'll add way down here, it's down, because this can just easily keep dropping.
Right.
But eventually, the moving average will come down to meet the price, right? So it won't go down forever in that sense. But let's see what we don't get here.
Okay, there you go.
Positive
Wouldn't that...
Yep, so if we want to, we can grab this candle and we can grab that guy and see how it would have worked out. Let's plot a target right there. That would have been an entry. Let me move that up just a little bit. All right, so we would have stopped out.
Stopped out.
Yep, but we got another opportunity right here. Let's consider this another loss. right? Just for fun. Because we don't, like, our initial stop loss could have been here. We could have just stopped out. So let's just keep going. We got that guy and that guy. No entry. All right. Well, let's keep it there. I mean, we got candles below here, so we can ignore that, right? No good candidate there. And this is more of the same, right? We just don't trade.
Yeah.
All right. So we got a positive slope. We got that. Let's see what we can get here. It's probably up here somewhere. Just measure that real quick. So 1% down, 2% up. Oh man, I'm losing my touch here. I'm a couple cents off. All right, let's see if we get it. Nope, we got to stop out.
Nope, stopped out.
And that's okay, right? And then it blasts and then we beat ourselves up, right? But it's okay, right? We had no idea that was going to happen.
Right. It
so
could have gone either ways.
Yeah, it's a little bit silly to blame ourselves for that because we also didn't know that this was going to happen or this was going to happen, you know?
Right.
But we always blame ourselves.
A quick question: how do you get that colored SMA line, the red and green?
Yeah, so this is a script that I wrote. You can have it. I'll put it in our chat. Do you know how to add a script on TradingView by chance?
Yeah. Yep.
Okay.
Yep.
Yeah, I'll just give that to you then.
Yeah.
And that's just the slope of the moving average.
Oh, okay.
Yeah, so I put it in our Discord chat so you can have it. And then we'll just go from there.
Okay.
You know, so here's another one. This risk range is a little bit big, right? So we can identify that. Maybe I don't like it, right? And if it goes up, what are we going to do? We're going to beat ourselves up because we missed the opportunity, right? But if it goes down, we're not going to do the same thing. And that's where the psychology comes in. So in this case, it just happened to have gone up.
Yeah.
Right? So this is emotional blackmail right here that we're giving to ourselves. So it just keeps going, right? All right, so it's coming back down. We get some small risks. Like maybe we looked at this guy. You know, this is what typically happens, right? You're going to see some opportunities like this. You're like, it's high up, but it's a super tiny risk. I'm okay with it. And then it stops out, and then you're like, I'll grab the next one. All right, so in this case, this one wouldn't have had an entry.
Right, so you go to the next one.
Just walking it down. No entry. So then
no
you just
entry.
keep walking it down, right? It's going to go up or down. That's all you need to know. Okay, so in this case, we would have had an entry, but...
Entry.
Yep, so now the trick here is to not look at this stuff, right? Because what are we going to do? We're going to say, oh, this one's going to do the same thing, and it's going to go up here, right? But it doesn't do that, right? So most traders at this point, this fork in the road right here, with any strategy, they would probably overcommit to this position because they say, oh, it's the pullback, it's a retracement, it's going to blast now, and it's going to go to new highs, and blah, blah, blah. That's where you get hurt. So it's a bigger risk range. We know that the 1% rule keeps these exactly the same. But they're going to overcommit. They're going to put 80% of their portfolio in that and probably get hurt if it goes down because then it's going to make it that much harder for them to compromise. Or, sorry, to not compromise. And they probably would have sold out like right here or something, maybe.
Right here.
You know, so we don't know what's going to happen. We don't know when it's going to happen. I mean, this trade would continue going and we would have just stopped out right there. And that's it. We have no way of knowing what any of this was. And if we had this kind of influencing that and expecting it to go from, you know, from there to like up here somewhere, we're just going to get stressed out if that doesn't happen.
Right.
Right. So in this case, you know, this is why it's, you know, you got to back test in conditions where it's not perfect because, you know, just default to the cautious side of things. Right, red slope, we can avoid all this stuff. Price will eventually turn around. Here we go. All right.
Okay.
Let's get ourselves a red candle. Ideally a small one, right? No red candles yet. Okay. So
okay, there you go.
We got one here. Right. All right, so we got an entry. Let's measure it out.
Entry.
We got 1.7, so 3.5-ish. Right about there. Let's see if we get it. All right, so we hit our target. So it's out of the jar. And this would have been a 1% rule because that's greater than 1%. So guaranteed 1.25% net profit. Let's go ahead and see where it goes. So we've got 1, 2, 3, 4. We don't get our fifth candle. Okay, so let's take a look, see what we get. 1, 2, 3.
Nope.
We do have a higher validated low candidate right here now. No, we got another candidate right here. Another one. All right, so this is our higher validated low candidate right here. Okay, so I just move this full stop up to here. And then we got 1, 2, 3 candles in a 5 candle run potentially, 4 or 5. So there's our fifth candle threshold right there. So now if this breaks, we move it. All right, so we would have locked in another 75% of our shares right here. Now that's below the initial target, and that's okay because we're still locking more and more shares above our entry, and that's all we care about.
Right.
Now if we get 2 more candles here, nope. All right, so we would have stopped out. I was going to say if we get 2 more here, we move our stop loss up, but we just stopped out right there. So that probably would have been about a 1.5, 1.4% overall return on that. And people are going to look at that and be like, oh, it's only 1%. You suck. But it's 1%. Sorry, 1% overall P&L.
Overall, right.
That's what matters.
Right.
All right. So is this something you feel like you could do 10 times in a row?
Oh, yeah. Yep.
Absolutely. Not in real time. I'm just saying go back in time.
Paper trade, right.
This replay feature.
Back in time. Okay.
Yeah, test it out with the replay feature. Just pick a random stock, zoom out kind of, and then just hold the left arrow. Just look at something else. Go listen to TV for a little bit, and then come back, or just pick a random date. You can go to like a random date generator, and just go back. We could pick like Apple and July 12th, 2022. I'm just making it up. July 12th, right? July 12th, I said. There we go. All right, so let's go ahead and just peek at it, right? Oh, look at that. Okay, so we got a red candle and a positive slope. I promise that was random. I promise it was random. I didn't. All right, so entry. Stop out.
Stopped out.
All right, but that's okay. All right. And then we beat ourselves up. All right, so we got a red candle here. And just grab it.
With a bigger risk range.
Yep, so that tells us we're going to do the 1% rule if we decide to take it. If we're not comfortable with it, we don't have to. There's our entry. There's our target. I assume it's somewhere around here. 2.7, 3.4, or 2.7, 5.4. So these numbers are not my strong suit today. All right. So that's our target up there. So let's see if we get that. Okay. So we would have hit our
target
5%. Yep. And we also got a higher validated low along the way. So we could have moved this up early, right? I don't like moving the 5 candle stuff up, but I do always try to move the higher validated low stuff up. So 1, 2, 3, 4, 5. So now we have our 5 candle run as well. So we would have locked that. And then we just look for a candle or another series of 5. So this one, what's the low here? 159.63, 159.50. So this is not a candidate, right? This is not a candidate, so let's just keep looking for one. 5 candle run.
There you go. Yep.
5 candle run, so we lock that in. And eventually you're just going to run out of shares, right? So there's another one, there's another one. That's a 7 candle run, 8 candle run. Right? And we would have locked some of the shares right there. Yep. Now our original stop loss is way down here still, so let's see if we can get that candidate. Nope. Just keeps going down. There we go. All right, so we would have moved our stop loss up a little bit. But that's okay, right? We only have a small piece left, and we're just increasing our net profit. So we got 1, 2, 3. Let's see if we get a 4 and a 5. Nope.
Nope.
All right, so we would have stopped.
Oh, there you go.
That's it. So our entry was, no, sorry, it was right here. So this was our entry. That was our original stop loss. And that's, where we took some profits way up here, and then we took the rest of them right here above our entry. I'd call that a win, right?
So this total took 1 month.
Yeah.
Close to.
Yep.
Wow.
Yeah, so if you get, a little bit. Now, there's also a little bit of a misconception here, and with the 1% rule, because our brains naturally want to say, okay, to achieve 1% overall, I have to put all of my portfolio into this position. And that's not true. You can have like 5 of these running side by side because, one might cost $350, one might cost $200, one might cost $600. They're all different.
Right.
So you're really just looking for ones that fit your budget and your the 1% slots, right? So in this one, for example, if the price is $145 and you're on $1,000 account, your 1% is $10.
$10, right?
Yeah. So you'd probably be able to buy like maybe 6 shares. Which means that if your risk range is like, 50 cents or something like that, you'd have to do a little bit of math there. I got the spreadsheet for you if you want that.
That would be great if you can send it out.
Yeah, for sure. I have it.
Pinned on the channel?
I might. I think it might be in the Rags to Riches channel. Let me just check that real
Okay.
quick. Over on here. Yes, I do. Okay, so it's the 1% rule cheat sheet that I have pinned. It's the third message in that channel.
Okay.
Yep.
I'll get it.
All right, feel free to abuse that. That's nice. You'll want to make a copy, obviously, because the master copy won't let you edit it.
Okay.
Yeah, so this is kind of the homework that I gave to Cicero. Is just pick a random ticker and a random date. And if you want to just go to ChatGPT and be like, give me a random ticker and a random date, do that 10 times.
Yep.
And then you and I should get the same exact results if we're both following the same strategy, right?
Okay.
Oh yeah, so yeah, that's negative. All right, so they don't all have to be the same 10. Right, so you can do 10 different ones, 10 different dates. I don't really care. But I would like to have you try that. Do you feel like that's something you might be able to squeeze into your schedule?
Yep, for sure.
Beautiful.
But this weekend should allow me to do that.
Perfect. Okay.
Yep.
And that's the beautiful part about backtesting is there's no time crunch.
Time limit, yes.
Yeah, you don't have to wait.
So that's why I said weekend. I can definitely pull out the time. So I would pick up a random ticker, random date, and then I will follow it through for each trade. I just note down the numbers and then send it to you so you can validate.
Yeah, just give me the date. Ideally, you document these as much as you can, like when specifically you would have entered, what the price was, where your stop loss would have been, where your target would be. But that can all just come from the spreadsheet because it'll tell you that stuff, so you're cheating a little bit. And then you would just, basically, you would tell me the sequence of events. So in this case, over here, for example, you'd mark down, like, you started looking on July 12th. Okay, and maybe you entered on the open plus 1 cent here, you had your stop loss here, you stopped out on the first trade. Second trade, you entered on July 19th at this price, your stop loss was here, you hit your target, you had a higher validated low before that, so you moved your stop loss up, then you took profits at the target, 75%. Then you had whatever higher validated low, you had the 5 candle sequence here, right? So you lock another 75%, and then a higher validated low over here, so you would have moved your stop loss up to 152.69, and then price came in to hit your stop loss, you exited completely. So just that sequence of events, I think, is really what I'm after.
Okay.
Because what I want to do is I want to do the same exact dates and tickers, and then I want to see if our sequence of events matches up, because what that tells me is, it's not so much about you using that specific system, but it shows me that you're able to adopt a checklist and follow it consistently.
Okay.
Right? So if we get different results, I can then go in and say, oh, well, this is what we're doing differently. And then we can kind of, fine-tune stuff a little bit. So.
Yep. Sounds good.
All right, beautiful. Do you have any questions about the position management side of things?
So how do we identify, the dividend stocks, right? Dividend, the 70% or the 50% that we allocate for the dividend-based, how do we identify those? Is there any strategy for those? Is there any screeners?
Oh, yeah.
And I also had a question of how do we build those screeners? What do we look out for when we build the screeners?
Okay, yeah, for sure. And that's so with you and Cicero both, maybe I've taken a backwards approach here, because most of the time I try to get people into that stuff first so that they can build that passive income. But I know people are human and they want to trade too. So I tried to give you guys a little bit of a treat here and give you the technical stuff first. Part of it is also seeing whether or not you're able to keep 75% of your stuff on the side without spending it. So for dividend stuff, that's actually pretty easy, because all we're looking for is 3 things. We're looking for the company to be making money, so we can look at financial metrics to determine that. How's their revenue over time, EPS, all that good stuff. And then the second factor is that company willing to reward shareholders? Right? So are the CEOs making money, and are they willing to share it? All right. And then the third item is, how is the history of their dividend growth over time? Is it a company that's been paying a consistent dividend for 30 years? Or are dividends the first thing they go to when they hit financial struggles? Right? So there's slightly different areas we can look into for that. So just kind of the brain dead approach for most traders is going to be to load up in VOO, which is a Vanguard ETF, and Schwab, SCHD. Those are my 2 favorites because they're diversified across all the sectors. And then you can also throw in O or Main for monthly income. And they're relatively cheap for their yield. If you want to get into like the real estate aspect of it, because housing isn't going anywhere.
Right.
Yeah. But I'm pretty heavy into VOO and Schwab, and I like Johnson & Johnson and things like that too. But a lot of that's covered in the video episodes, but I want to recap it with you guys a little bit more deliberately, because there's also, it's not just the companies themselves, but the role of the dividend position within your portfolio that matters. So what I mean by that is that if you have a stable, low yield company that's been increasing their dividend, like O, for example, it's a nice cheap dividend stock, and it's been increasing its dividend for like 27 years. It's awesome. And then you've got maybe a high risk, high yield ETF dividend that you want to balance against that relatively stable position, because you're going to get a more aggressive dividend yield on that one, but the share price is going to suck. It's going to fall off. It's going to take some money
right after
away.
the dividend payout.
Yep. Well, they all get adjusted, but the high yield ones can't outperform that extraction, that price adjustment. So they tend to go down over time, and that's just because of the strategy. They use a synthetic covered call strategy. So when the price of the underlying goes up, yeah, they go up, but typically they lose value over time. But that's okay, because we want that sort of thing to protect our bigger, more stable shares, because think about it at the end of the year, right? When you're ready to sell for tax loss harvesting, you don't want to sell those stable dividends that you got good prices on, and you want to hold for more than a year to get those dividends and the tax burden reduced.
Right.
You want to sell the garbage that's going to deduct your, you can use it on your taxes as a deduction to offset your capital gains income. So there's a purpose for those crap ETFs. And all the while you're collecting aggressive dividends throughout the year on those as well. So it's like playing cards. You just have to know kind of what your moves are and how to stack them against each other. And it requires a little bit more finesse than just looking at financial sheets. So we'll get there. I just want to make sure that if you're looking for dividend stuff right now, I would recommend just looking at those three things. Is the company making money? Are the CEOs happy enough about that to share with investors, or are they doing it out of desperation to attract interest, right? Because we can see that all in the filings. Does the company have good partnerships? Do they have debt obligations that they have to raise cash for? Are they going to drop an offering? Do they just dangle dividends in front of people just to get them to buy it and then drop an offering, or pull the dividend? So there's a bunch of different things we're going to want to look at. And then the third thing, obviously, is just that stable growth. So if you want to look just at some of them, let me go ahead and share I'm going to just change my screen share a little bit. And this is that cheat sheet that I was referring to. If you want to just go to stockanalysis.com, you can just type some in, right? So I'll just start with O here real quick, just so you can kind of see what a good one looks like. If you look at the financials, this is stockanalysis.com, by the way. If you look at their income, you can put your mouse over these and it will show you. So this company's rental revenue, for example, over time has increased.
Has grown.
Yeah, so that's just a portion of their revenue, so it's not something that we need to hinge everything on, but their total revenue is up over time, which is great. Operating income, that's the difference between how much they make and how much they spend. That's what they have to work with. So that's increasing over time. That's pretty good. Pre-tax income, that kind of depends on sector. We don't really care too much about that. Net income we do care about. That's up over time. It's not the greatest. It plateaus a little bit, but that's okay. And we'll get into the specific things to look at and all that good stuff. Dividends per share is flat, but it's increasing, which is kind of this stock's superpower specifically. EBITDA also, that's a sector-specific metric. Like tech stocks, for example, they're going to have a different weighting on that than the financial bank service, for example. And then let's go ahead and just really quickly peek at the balance sheet. How much do they have in assets and how much do they have in liabilities? So how much can they sell if they need to cover their bills, right? That's what assets are. Assets also carry tax liability for a company, so that's worth considering. If they got a lot of assets, they're going to pay a lot in taxes. Liabilities here. So roughly they have more than a 2.0 ratio. So they have more, like twice the assets to liabilities. That's a good mix. Right? Then within there, I'd like to look at the current liabilities, current assets, and that's just the, if they lock the doors, how long could they survive in numbers of years? So, little things like that. Their shareholders' equity. This is pretty good. It's solid. It's up over time. And then we'll look at cash flow really quick. Net income, we already knew that's up. Cash flow is pretty good to have. Investing cash flow, that's going to be negative for this guy. Net cash flow is this is variable, right? And that's kind of sector specific as well. But what we're really interested in here is the dividends, and I'll kind of show you where this one shines. So it's a monthly payout. And it's
Mm-hmm.
you're getting the crash course here, by the way. we'll dig into all these specifically.
Try again in a few seconds.
So 5% dividend yield, that just means that they pay 5% over the course of a year. So you're not getting 5% per month on the shares.
Okay.
That'd
Okay.
be way too much.
Yep.
Yep. So that number divided by 12 is roughly what you get, or $3.16 per year. So it's not a lot.
Mm-hmm.
But
Mm-hmm.
what's really, really cool is this number right here, growth years. So this company is
Continuously giving the dividends.
Yep, which is unheard of
Mhm.
with a $60
Uh-huh.
stock.
Uh-huh.
So this is kind of a run silent, run deep scenario. So if you scroll all the way to the bottom here, what you can see is their dividend payments have gone up consistently over God knows how many years. Now their dividend growth, even though this number might have a negative slope and stuff, it's still growing. It's still above zero. It's just more or less rather than greater than zero or equal. So it's good. And this chart should always go up if you're looking for a long-term investment, in my opinion. Right? If this goes up sharply and then sells off, that means that the company is pulling the dividends to make up for other stuff.
Right. Okay. Okay.
So now if I look at a company like Pfizer, for example, just picking random ones here, they also offer a dividend around 5% a year. Now their dividend is $1.68, and they're a $30 stock, so not bad so far. I haven't looked at the financials yet. Their growth years is 13%. Right, so if we go down here, we still have a positive chart, and we still have above zero dividend growth. So that's pretty good. That tells me that they're willing to pay investors. That's sloping down, so it's maybe worth keeping an eye on, but it's okay. So then I would just look at the financials really fast. It's above zero. It's great. It's all right. Now their operating income is going to take bigger hits because they need to manufacture a lot of stuff. There are a lot of research, a lot of ebb and flow in their catalysts. So let's look at their EBITDA here, for example. Kind of irrelevant, right? They're not, they don't operate the same way. Dividends per share, that's solid. It's increasing. That's what we like. So I would say this is a pretty decent candidate, right? And then what you want to do after this stuff, once you kind of identify the right things, the key metrics here that matter, and you identified a good dividend history, then you want to kind of look at the sector, right? How is this company performing relative to the sector? Then you want to kind of look into the company itself. How do they make their money? What kind of future do they have? Do they have good partnerships? Do they have any heavy obligations to a supplier? They have a history of burning other companies. How are they making their money? What does the company do that's reflected here in the CEO making money and wanting to give some back, right? And then once you do that, the very, very last step is just buy some and then consider trading some short term if you want.
Oh, okay.
And that's it. So that's,
and then from the 70% portfolio perspective, you just buy them and keep them aside so that the dividend do we reinvest the dividend as well? Or we just get the money back?
Yeah, so basically when you buy the shares, or I guess when a stock goes cum div or with dividend, that means that the dividend is about to be removed. So when the ex-div date hits, a portion of the share value is taken off the shares and it's converted into cash at the payout date. So that obviously counts towards taxes because that's considered, income. You're getting
income,
paid. Right? But it adjusts the stock price, so you're not going to see necessarily it won't make your position red, but your shares will be they'll be at a lower price, right? So you're going to lose money on that part. All the stock needs to do is outperform 5% per year, and it can afford to stay above zero with those dividend payments. Right? That's all it's got to do. So when it comes to the dividends, once those payments roll in, they'll just land as settled cash because they're a cash payment. Now it's up to you to reinvest those if you want to, or you can speculate with that. But I personally like to put them into the dividend passively. Just reinvest them over and over and over again because that compound growth machine is going to kick up and it's nice.
Right.
Yeah. Especially if you're continuing to make contributions and you're taking little profits from your speculation stuff and just feeding it into that as well and keeping that nice and trimmed down to a smaller amount that's familiar. The machine, it's nice.
Right.
Yeah.
Okay.
Yep. And then ultimately it's up to you. A lot of people, once they start scaling up, you can incorporate different strategies. If you want to take, for example, let's say we're in an election year, right? So if you've got a relatively moderate sized portfolio and you want to hedge this, right? Like you know roughly what your portfolio beta will be, or I can walk you through how to calculate that, but it's a little bit more advanced. But you know that if things sell off, you'll be able to hedge with put options, for example, by a certain amount, right? And that'll keep your portfolio flat when there's chaos in the market, and that's just how the big boys do it. They hedge. Right? Now, if you're buying puts to hedge, you need to at least make that much money in the passive side to afford the contracts, right? So there's some magic numbers that we can work through, and we can do a little bit of math and say, okay, I can afford to start hedging now. I can afford to start using, I can sell cash or good puts to acquire my shares now and get paid to buy shares. There's just new strategies that you'll be able to layer in. And as long as you identify the purpose of each and you know that each one has a specific role, you can really, really optimize the process. But for right now, if you're just looking to buy and hold and collect dividends and just take those payments and put them right back in the stocks, that's a very tried and true method, and that's what most people do for investments. Yeah. Because you're just getting paid to hold shares, and then that money can just be used to buy more shares. So that's every business model, right? You buy something, you make some money back from it, and then you just reinvest it. That's it. And once you get that collateral up, you get the size of your portfolio built up, because right now it's just a savings account. Right? So you control the interest rate. So once the size of that portfolio gets up and you got enough collateral, then you can start doing cash secured puts. Instead of just buying 100 shares, you can place an order, and whether or not you get filled, you're still getting paid. You're just getting paid to place that order, which is pretty nice.
So what happens in that scenario? I've heard Quench talk about this, but I didn't understand the concept. Say, for example, if I have 100 shares, right, of a particular stock, you're saying I can sell the options for that 100 shares, right? Is that right?
Yeah, so that's a covered call. So that's just a fancy way to sell your shares, basically. So when you sell, all right, let's say you got 100 shares, all right? A call contract is just the right to buy shares. Right? So you have that because you have the shares. All you need to do is sell it to someone. So the way you sell it is with a call contract. So you sell the call contract to someone else. They buy it. Every single one of us has been burned by buying contracts, so it's nice to be on the other side of that. And then basically, if the price goes up, they're going to want to exercise that contract. A bunch of people are going to be selling it to each other and all that good stuff because they're speculating. But when it's time to resolve that contract, someone's either going to want the shares or they're not. Right? You've already gotten paid to sell just the right. But if the price goes up and they exercise the contract, or if it gets assigned, you have to sell your shares because you've sold the right to buy the shares to someone else. So they're just using that right, and they're buying.
At that point, I'm obligated to sell the shares to whatever price they logged in for, right?
The strike price of the contract. So you're guaranteed that profit plus what you've collected in premium when you sold the contract. So it's a very easy way to make money. The downside there's two downsides, right? The first one is the capped profit, right? Because you have to sell at the strike price, and if it goes up 1,700%, you're still getting just that strike price. So it's okay for most traders, right? And then the other downside is if the stock drastically sells off, you're going to have to lower that average to get closer contracts so that they're actually worth selling. So if it's a long-term hold and you really don't care and you plan on buying more anyway when it's down and it's just a long-term investment, selling covered calls when they're available is a great way to make money. Yeah. But if you're going to freak out and get stressed if the price sells off because you don't know what to do, and you're not going to want to sell covered calls because then you're kind of locked in, and you'd have to buy the call back, and that call is going to increase. It's not a good time.
Right.
So yeah. So you just got to be aware of the risks, but we're going to build into all that stuff just like we did when we started the project. But for right now, I kind of gave you guys the technical analysis stuff first to give you some busy work to kind of get you to get a couple contributions in your portfolio. Just kind of start off slow, right?
Okay, sounds good. Sounds good.
And then
this is good.
Yeah, absolutely. So I think I'm a big fan of not walking away with concepts, but I want you to walk away with something specific, right? So for this week, or until we meet again, because our schedules are both a little bit crazy, and I'm actually supposed to be going to Chicago next week, so I don't know if I'll be around. I would like you to do at least 10 back tests by the time we talk again. If you can't, that's okay, but just try to do as many as you can, up to 10, right? Because we don't want too much. Well, do as many as you want, but let's just look at 10 of them.
10 of them, right.
And then I want you to look at one stock. No matter where you hear the ticker, I don't care if somebody else tells you it's a good stock. I want you to look at that company to the best of your ability, right? And I'll help you fill in the gaps and stuff, but I want you to just do it on your own first. Tell me what you think of the company and what you're using to justify it, and just do like a little bit of a write-up about that.
Is it for me to justify purchasing that stock?
If you want to, you can, if you can justify that. But I really, my personal interest
But
is...
the write-up is for justifying the purchase.
Yeah. I want to see what you're looking at, what you see, and how you're seeing it. And then we can look at it and say, well, okay, well, this actually means this, or in this context, this means that. So we can look at it a little bit more closely, but I kind of want to take an inventory and just see where you're at. That also helps me as a teacher, because then I can see, like, okay, well, what do new traders typically view this as? Right?
Okay.
Yep. So 10 back tests and 1 small write-up.
Small. Okay.
It doesn't have to be 2,000 word essay, I promise. All right.
Sure thing.
Alrighty. Well, I appreciate your time. Do you have any other questions?
Not right now, Pookies. Thank you so much for your time.
Alrighty. I appreciate it, and I look forward to seeing what you got.
Same here.
All right. Thank you. Have a good day.